Bloomberg Audio Studios.
Podcasts, radio, news.
This is the Bloomberg Surveillance Podcast. I'm Jonathan Ferro, along with Lisa Abramowitz and Anne-Marie Hordern. Join us each day for insight from the best in markets, economics and geopolitics. From our global headquarters in New York City, we are live on Bloomberg Television weekday mornings from 6 to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app. That's Yardeni of Yardeni Research setting a year-end S&P target of 7,700 and a decade-end target of 10K. He writes this bull market could be one of the longer ones. Ed joins us now for more. Ed, good morning.
Good morning.
Let's just start with the longevity of this thing. Already several years into it. Why do you think this can take another leg and another leg higher after that?
Well, I think the economy has demonstrated its resilience over the past few years. I mean, all the shocks that have hit it, starting with the pandemic and then the tariffs most recently, and yet real GDP is at an all-time record high. And so I'm just extrapolating that continues, that the economy will continue to grow through the end of the decade, and that by the end of the decade, we could very well see the market anticipating something like $500 a share for the S&P 500, put a 20 multiple on it, and you get 10,000.
Certain things happened last year that people thought would be relevant and turned out to be irrelevant. I'm thinking of the tariffs of April of last year, irrelevant to the headline S&P 500 index at least. And then later on and through the year, the fact that unemployment carried on climbing and it didn't seem to disrupt this equity market. Is that going to be the story for 26 as well?
Yeah, absolutely. And I think 2025 demonstrated that the economy could grow even when we have a labor market that's not growing much at all. And that can only happen if productivity is booming. And productivity growth during the first half of the decade kind of recovered. It was really quite depressed at the beginning of the decade. It's recovered to kind of its annual average of about 2%. I think we're heading to 3%. And going from 2 to 3% doesn't seem like a lot, but it is a lot when it comes to real GDP and keeping a lid on inflation.
As you know better than most, what often happens coming into the new year, people look for the other thing. Not the thing that's been working for years, but they look for the other thing. Is it time to move away from tech and get to the other thing?
Well, I'm in that camp. I'm in the notion that it's time to rebalance them. I mean, when you've got information technology and communication services accounting for 45% of the market cap of the S&P 500, maybe it's time to rebalance a bit. And I've been recommending also overweighting financials and industrials, and now I would continue to overweight them and put some money also on an overweight basis into healthcare. Look, I think every company is basically trying to be a technology company. You either make it or you use it. And so I am kind of keen on the impressive 493. Everybody's focusing on the Magnificent Seven. But I don't know about you. I'm getting AI fatigue. I'm a little tired of the whole thesis here. And I think the market's starting to show that as well. And the 493 are looking more interesting because they'll be the ones that are using the technology to increase productivity and earnings.
Last year, there was a big overhang on questions of how tariffs would impact companies and thus their share price. What do you think is going to be the big policy question mark of this year?
Well, I think everybody's focusing on the fiscal stimulus that's kind of locked into the system with the One Big Beautiful Bill Act that was passed last July, but it was retroactive to the beginning of last year. And so, according to Secretary of Treasury Bessent, a lot of households are going to get an extra $1,000 to $2,000 in refunds more than would otherwise have been the case, and that could be very stimulative. We already have very stimulative monetary policy. The Fed's cut the Fed funds rate by 175 basis points since 2023. And so, you know, I think the policies are kind of locked in. And the question is what kind of impact they'll have on the economy. Obviously, a positive one, but the big question is, what about inflation?
Well, given they're locked in, do you think consumers already preemptively spent those checks they're about to get?
I don't think so. I think they're going to be pleasantly surprised by the refunds. I mean, you know, claiming your refunds is not something that's easily to predict. So I do think there's going to be a stimulus from it.
Where do you think this will leave the Federal Reserve and policy for the year ahead?
Well, we've got a lot of known unknowns. We'll see who the next Fed chair is, but we also know that whoever is the Fed chair, it's only really one vote on the FOMC. So the Fed's going to remain data dependent. And I think that with the economy likely to be quite strong, at least in the first half of the year, I think the Fed's done, at least for the next 6 months.
One man, one vote is not how we've been thinking about the Federal Reserve over previous leaderships and previous administrations. Why is it changing?
Well, the previous Fed chairs were consensus builders. That's what they spent a lot of time doing, and they was very successful at it. Particularly Fed Chair Powell was a great consensus builder. But I think the next Fed chair is going to be much more aligned with the president, with the White House, and I think there could be a lot. I think there could be a lot more independence among the Fed committee members.
Is that the unintended consequence of this push by President Trump?
I mean, everybody's been talking about the Fed's going to be less independent. I think they'll be more independent. I think you'll see more dissension.
You mean they're going to be more independent because it's so obvious potentially the Fed chair is so tethered to the president? Everyone else will feel like they can be honest and speak out?
Yeah, well, if you got a Fed chair that's Trump dependent and everybody else is data dependent, I think you're going to have a difference of opinion. And it's going to be pretty visible, as it has been in the last minutes.
When you say that they only have one vote, do you think this administration might take a different approach when they think about the Fed and potentially elevate a Governor Waller so they get an extra seat because it is a deliberative body?
Well, I think Waller makes the most sense because he's got the experience, he knows all the players, and he could be more of a consensus builder than somebody that's just kind of a new figure at the Fed. I think whoever is the next Fed chair, they're going to realize they have a consensus problem and they have to deal with it. And so I think at the end of the day, the Fed's isn't going to be much different than what it is right now. Even if the president continues to, demand that the Fed funds rate be brought down to 1%, it's just not going to happen if the economy is doing well and if inflation's still kind of stuck around 3% rather than down to 2%.
Stay with us. More Bloomberg surveillance coming up after this. Former senior U.S. intelligence official Norman Roule writing the following. In addition to ensuring U.S. influence over Venezuela's oil reserves, the administration will seek to reduce China's political influence over a region. Norm joins us now for more. Norm, welcome. We talked about how impressively clean this operation was over the weekend. Given your experience, given historic examples of similar events, what was your reaction to what took place?
Extraordinary display of the skill of U.S. military and intelligence officials working together for many months and then putting an amazing array of U.S. military and intelligence operatives together on the ground. But it also showed the extraordinary nature of U.S. technology. The Venezuelans talked about having air defenses that could spot stealth fighters, and the United States managed to put not only dozens of aircraft but helicopters throughout Venezuela's skies, and Venezuela's air defense was not able to pick it up. Now, put that in context of the U.S. military technology being used by Israel and the United States in Iran just a few months ago against Russian and Iranian technology in Iran, and you really get a picture of the extraordinary capacity for U.S. military technology, personnel, and intelligence capability with our partners worldwide. It's quite a picture for our adversaries and partners.
Iran was the big focus in June. Obviously, Venezuela is the big focus now. Norm, what country could be next where the U.S. has a more aggressive foreign policy?
I think it's important to take a real hard look at the December national security strategy, because the national security strategy makes clear that the United States will be inclined to be non-interventionist, but use robust military and economic force, most likely in the Western Hemisphere, and then otherwise use economic and military tools only when needed outside of that environment for limited purposes, not state building, not to to put new governments in place. And I think that template has been consistent for the administration throughout the previous year, and I think in 2026 as well. So I think the Western Hemisphere is likely to remain the administration's focus, but the Iranians have been put on notice. There has been some additional social media activity by the administration, and but if military activity were undertaken by the administration, it would likely be limited. This is not an administration looking to involve the U.S. in a conventional conflict.
When it comes to Venezuela and now the acting president of Delcy Rodriguez, given the fact that she was the number 2, her brother runs the National Assembly, she was by the Panamanian leader said this is Madurism without Maduro. Is this regime containment instead of change?
Well, I think you've got a couple of different issues here. So the U.S. posture, again, is being clarified as interest-driven statecraft. We're interested in stopping drugs, migration, adversary exclusion from oil. Democracy restoration is being positioned as a downstream objective. Now, let's put this in the context as the Venezuelans. They've just seen an extraordinary display of U.S. power. They cannot compete with this. They have no allies of any consequence. So they're going to try to do several things. First, they need to buy time. They need to sustain internal cohesion. They need to delegitimize any potential successor. And they need to then think about how do they manage this environment while Congress, the rest of the world, puts themselves together against the Trump administration, and then seek out maybe overtures for a negotiated coexistence with the Trump administration, if only to prevent follow-on strikes and to maximize their influence in any possible ongoing transition.
Norman, we're tracking live pictures of the former Venezuelan leader heading to a court here in New York City, which is stunning in and of itself. In an ideal world, Norm, this is what people would like to see. They would have liked to have seen this guy step down a long time ago. And then the Nobel Prize winner walks into Caracas the following day to streets celebrating her arrival, and she takes over and democracy reigns. Norm, that's not the real world. Could you share with us the cold, hard reality of the real world and how difficult it will be to engage the resistance that hasn't yet shown itself yet in Venezuela, but could materialize in the months to come?
Well, to be clear, I'm not a Venezuelan domestic political expert, but for the Venezuelan opposition to take charge, they're going to have to overcome the architecture of the military, the security forces, the Cuban security forces who are ingrained within the architecture of the Venezuelan government, the entire political system of Venezuela, which will be among the first to be put on trial. I mean, the Venezuelan interior minister and the new president will be among the first to be put on trial for corruption and human rights. So they're going to need a safe haven, a amnesty. This is an awful lot to ask for. So the president was not out of his lane to say that it's going to be a tough road to hoe for the incoming president to just step in. And I think for this reason, the Secretary of State was also accurate to describe this as a process. But in any case, this is a situation in motion.
Stay with us. More Bloomberg surveillance coming up after this. Let's stick with the energy market. The US, of course, ready to use the commodity for leverage in Venezuela.
There's a quarantine right now in which sanctioned oil shipments, there's a boat, and that boat is under U.S. sanctions. We go get a court order, we will seize it. That remains in place. And that's a tremendous amount of leverage that will continue to be in place until we see changes that not just further the national interest of the United States, which is number one, but also that lead to a better future for the people of Venezuela.
Bob McNally, the founder and president of Rapidan Energy Group, joins us now for more. Bob, as you and I start this conversation, we're tracking live pictures of the former Venezuelan leader making his way to court here in New York. This is an individual who oversaw the biggest energy reserves on the planet. And this was a sector, an industry in that country plagued by underinvestment. Can you frame for us, Bob, how long it would take to really scale up production in that country now that individual is out of the country?
Hi, Jonathan. Sure. It's a matter of many years to decades and tens of billions of dollars. The good news is, especially U.S. companies, they know how to do it. They have the engineering, logistical, technical expertise, but it's going to take boatloads of money, and we won't be seeing real oil until after the end of the second Trump term. We just need to be realistic about that.
But Bob, is the will there, given the fact that these are companies that had to flee Venezuela in 2007?
Absolutely. You know, they're tantalized, but they are cautiously tantalized. I was in the White House 23 years ago after we were chased out by Hugo Chavez. No fun at all. And they will be very cautious in going back in. But it also gets to this transition. What kind of government are we going to have there? What kind of contract terms? What kind of physical security? There's a wide and deep set of big questions that these oil companies and their boards are going to consider before they rush in. I think it's right that they're up in equity pricing. The market's got this right. It's a nothing burger for short-term crude futures. It's another tailwind for U.S. oil companies majors coming after this sort of walk back from this peak demand narrative. If you think about it, U.S. oil majors have just had a great extended holiday season. Peak demand is fading in 2030. That's good for them. And now the world's largest oil reserves may be available to them when it really counts after 2030.
Well, you also got it right. I actually thought of you in the morning after this all took place, because before the Christmas holidays, you said there was a 70% chance that Maduro would be out. Did you think it was going to happen this quickly? Yes, we did. I think the market has gotten, you mentioned June in the Iran war. The market doesn't understand Trump. It was surprised when he attacked Iran. It was surprised when he put sanctions on Rosneft and Lukoil in October. And it was surprised when he removed Maduro. I think what the market doesn't understand is the president's willingness to take risk when it comes to confronting adversaries on top-tier foreign policy challenges, even if energy is at stake. And the reason why, Anne-Marie, and you just mentioned it, the president, the White House believes, and I happen to agree, we're heading into oversupply. He can lean into this softening crude market and take risk, even with Iran and Russia, which are really more important near term than Venezuela. So what are you telling clients is the next potential risk-taking this administration is going to go for? Iran and Russia are up next. Look what the president's talking about. Israel is not kidding about preventing Iran from reconstituting its missile and nuclear programs. And with the unrest we're seeing there, maybe stirring the pot. So the president's been talking very forcefully. Look what he said with Prime Minister Netanyahu, willingness to intervene if the regime shoots protesters. I think when the market sort of lifts its gaze from this fascination with Venezuela and realizes there's not a real issue in the short term, it's going to say, wait a minute, how credible is President Trump when it comes to Russia and Iran? With Russia, Putin's not going to agree to armistice. And while President Trump often has a friendly demeanor towards Putin, says nice things, he also tightens sanctions. And I think he's willing to do so even more into next year. So let's look to Iran and Russia for real potential supply disruptions, not Venezuela.
When you say they're up next, Bob, can you just give us detail on what you mean by that? Because up next, after what we saw over the weekend, is a very different scenario for Iran and for Russia. What do you mean by they're up next?
Well, I think if Iran doesn't agree to halt its missile capabilities, its reconstitution, its nuclear capabilities, and if we even see this continued unrest, I think there will be, and we told clients, 70% probability of another wave of at least Israeli strikes on Iran, perhaps supported or joined by the United States. We're at a solid 70% on that. Also, sanctions, tighter sanctions. We've let Iran off. Trump could go to China and say, cut it out. We're serious. Do business with Iran or do business with the United States. So really cutting into their oil exports at least, and military action at best, 70% probability in the coming, let's say, months. Putin, Russia, same thing. So far, they just wanted to widen the Urals discount to Brent. They just wanted to, hurt Putin's revenue, not cut into production. If oil prices keep falling, it's a big condition. If oil prices keep softening, I think he'll be willing to be tougher on India, China, and other customers of Russia's crude.
Bob, how consistent is that with the national security strategy that they put out at the end of last year?
You know, it is consistent, but it's subtle. You got to read into it. Trump didn't say, look, we're going back to the Western Hemisphere and we're all about not only the Monroe Doctrine, but the Trump corollary, which means we won't even let our adversaries have economic stakes in our region. That's what the focus was. But he didn't say we're completely pulling up stakes in Europe, the Middle East, and Asia. Didn't say that, not acting that way. We don't think China has a free hand in Taiwan. We don't think Putin has a free hand in Ukraine. And in the Middle East, we're going nowhere. So we're kind of having it both ways. I think we're having our internationalism, our global alliances, and the Eurasian landmass on the one hand, but telling the world, yeah, we're really going to be busy in the Western Hemisphere.
Anne-Marie, that was certainly part of the conversation over the weekend. Does this speak to the idea that maybe they're going to refocus everything on the so-called Western Hemisphere, ultimately Latin America, and take their after ball in places like the Middle East and Europe?
Well, what one thing is for sure is that they definitely are monitoring the price of oil. And to Bob's point, does that give them a lot more leverage around the world? Oleg Deripaska actually came out with a telegram over the weekend and was talking about how if the U.S. is able to hold prices near $50 a barrel, that puts serious pressure on Russia's state capitalist economic model. So already this is going to put pressure on all these other countries, even if the administration decides they're just focusing on the Western Hemisphere.
Bob, just before you go, I wanted to carve out some time and talk about a much longer term issue. The lifespan of shale. How are you considering the lifespan of shale with the developments that we saw took place over the weekend?
Well, we think shale is going to be around forever, and there are other deposits around the world. Look at what Argentina is doing. If the other shale deposits open up, we could see new, strongly emerging shale plays. In the U.S., we think it's a mature sector. We don't see a lot of net growth. But you know what? Look at AI, look at technology gains. Real big mistake to bet against, especially U.S. engineers, U.S. oil geologists, et cetera. And I can see us getting those recoverable reserves up from 10%. We get that up 10% more. I think that we can see surprises in our ability to produce oil. But look, it's high cost. It's vulnerable to supply price swings. It's going to be challenging. It's mature for the time being. So shale is sort of in a plateau for the time being. But if we get a surprise, it's not going to be the death of shale. It's going to be that, wow, we can recover a lot more. We even got more efficient.
Stay with us. More Bloomberg surveillance coming up after this. Well, here's the latest in the Treasury market so far this morning. Yields falling for the first time in a week on escalating geopolitical tensions, adding to the gains we saw through last year. A 40 basis point move lower on a 10-year maturity through the year. This morning we're down to 416.71. To discuss, joining us now is Jim Bianco of Bianco Research. Jim, welcome to the show, sir. The move at the front end, phenomenal, of course, in line with the rate reductions at the Federal Reserve. But it wasn't reserved to the front end of the curve. We also saw that rally in the longer end of the curve in a 10-year maturity, bit of leakage in a 30-year. We can get to that in a moment. Jim, what do you think was behind that move, given the Sal America story that really emerged in April, then was very quickly ignored in the back half of the year?
Well, I think we need to first put that in a little bit of perspective. In 2025, all the 10-year yields around the developed world were either unchanged or higher. The only one that was lower was the U.S. All the 30-year yields, not every country has a 30-year, were unchanged to higher, including the U.S. So there was only one long-term yield around the world that went down last year, and that was the U.S. 10-year yield. So something specific to the 10-year yield happened last year. Now, if I had to guess, it's not the GDP numbers, it's not the inflation numbers, because everybody else had very similar, I'm talking about the developed world, had very similar type of numbers, but their yields went up. I think the difference might be political, and that is the president has tied his success to lower 10-year yields and has been demanding that the Federal Reserve cut interest rates. And that had an effect in 2025. Whether it does in 2026 is a different question.
Jim, you're suggesting there is almost an implicit Treasury perk coming from the administration that's making people reluctant to sell that specific maturity.
Yeah, I am, because that specific maturity was the only one that was down. Now, if we had a bunch of them down on yield, like the U.S. Was down 40 basis points in the 10-year, then I would argue to you that, it wasn't. But there was something specific about that maturity. And I don't think that can last forever. It did last for 2025. So really, it's going to come down to what is the economics of 2026. Now, if it looks like 25, but we had strong growth. We had a 4.3% GDP in the third quarter, the last number we had. We had inflation that is still in the upper twos. We're almost 6 years past the beginning of COVID, and we're still nowhere near 2%. That those types of numbers will produce higher 10-year yields throughout 2026.
Jim, as you consider the rest of the world, not just the US bond market, but the global bond market, is the center of gravity for US bonds in the US? Or are the dynamics that you're speaking to actually elsewhere? Are they in places like Japan?
Oh, I think you're right that where it's not, if I could talk about the default, is it's not in China anymore. China's now fallen to the third largest country that owns treasuries behind the UK. And so it has definitely moved to somewhat in Japan, and that is probably a net negative. With their rates going up, the incentive to sell U.S. fixed income securities and move back to Japan, grows every day. So yes, then by default, it comes back to the U.S. and it comes back to Fed policy. And that comes back to how the growth is. And I'll remind everybody that if you look at the last Fed meeting, it was a 9-3 vote. But if you look at the way that everybody was talking, it might have been 10-9 among the 19 members of the Fed, whether or not they should have cut rates at the December meeting. So if we could continue to get strong growth like this, we might not see another rate cut through 2026.
Do you think 2026 will be risks or opportunities to market participants, especially given the stunning developments just over the weekend when it comes to foreign policy of this administration?
Well, there's always going to be risks, but I guess the real question is, where do the risks come? Do they come in denting growth or slowing down growth, or do they come in potentially pushing up inflation? And I am one that has been and continues to be concerned about inflation. What happened in Venezuela is a good long-term story for crude oil, but it might not even be a 2026 story for crude oil. If anything, it might be somewhat bullish for crude oil over the very short term as they cut off shipments to China that has to replace it by buying it from other places and pushing it up just over the very short term. But longer term, it could be. But I think that most of the risks that I see are going to lead to inflation staying in the high 2s to the low 3s, and the market starting to realize that a 3.5% funds rate and a 4.2% or so 10-year yield might be too low.
When it comes to inflation, what makes you the most nervous? Because many people were talking about tariffs last year, but we haven't seen a real impact on that.
Yet. And the reason I say yet is that while you look at the announced rates that the Trump administration has said about tariffs, it averages about 17 to 18% is what the tariff rate was. A year ago, it was 2. So we went from 2 to 17. But if you look at the actual tariffs collected, it's more around 10%. And I think that accounts for a lot of why you're not seeing the inflation in tariffs, because the collection of those tariffs takes time. But that 10% number has been moving up all year, and it's at its highest level in November, the last data that we have. And I suspect that number will continue to move up into 2026, and that tariff story about inflation might still be ahead of us, probably around the middle of next year.
Jim, let's finish on the unintended consequences of the president's push for lower interest rates. We spoke to Ed Yardeni earlier on this morning, and he echoed your argument that I want to give you some credit for as well. The fact that this has galvanized every voter on the committee, and it's a change from what we've seen under previous leadership at the Federal Reserve. Jim, can you just spend some time fleshing out what's happening here and why it might be consequential for the year ahead?
For the last 40 years, everybody votes with what the chairman wants. They talk internally, and then they come to an agreement before the meeting, and that's why you get these 12-0, 11-1 votes. But now it looks like the Fed is shifting to be more like the Bank of England or the Bank of Japan. And that is that each voter is going to vote independently, or think the Supreme Court. We saw 9-3. There was a good argument that you could have had a 7-5 vote. I've advocated that that would actually be a positive for the Fed, not a negative. Each governor, each president is supposed to represent the American people and vote the way that they think is the best for monetary policy. And there should be disagreement in that. And if they start to move that way, the biggest thing that could happen is President Trump could put somebody in place. That person could advocate for what President Trump wants, 1% funds, but does he have 7 votes to get it? And he might not have 7 votes to get it in 2026 if the economy stays strong and inflation stays sticky. And that could be a big departure from what we've seen from the Fed in recent decades.
Jim, is that one of the main pillars for your call for this year, that ultimately we don't get much action from the Federal Reserve?
Yeah, I think so. I think there's a lot of people that are thinking 2 or 3 cuts because we're going to get an uber dovish Fed chairman, because Trump is going to replace Jay Powell by May. But again, it really comes down to, yes, in the old way, the chairman would tell everybody how to vote and they would disagree internally, but they would do what he would want. But in the new way, they might just say, no, you just don't have the votes for it. We're going to vote otherwise on this policy.
This is the Bloomberg Surveillance Podcast, bringing you the best in markets, economics and geopolitics. You can watch the show live on Bloomberg TV weekday mornings from 6 a.m. to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app.